room for adjustment in that March report compared to the next report that's coming, which is the June 30 acres numbers. On average, that from March to June, there can be changes in what farmers intended or what they reported they were going to plant in March compared to what they actually end up planting in June. On average, the difference between those two reports is as high as 4 or 5%, which translates to 500,000 acres change is possible. I can think of some reasons why we might have more acres. In Texas, there's a lot of failed wheat acreage up in the rolling plains that has above average moisture on it, and so it's kind of an open question whether those acres, which that could add up to another 100,000 or pushing 200,000, if they got planted to cotton, then we'd have more than what the March number was measuring. So again, we'll have to see. I think there is a possibility of having somewhat more planted acreage in June compared to what they were guessing in March. We'll just have to see. But if that happens, then we may have a larger supply than what the market was expecting. This map looks pretty bad if you're in El Paso or Uvalde, but relatively speaking, it shows a better picture for the northwestern regions of Texas and most of Oklahoma, due to the moisture that's been received in the previous month. Now, will that continue? Who knows? It may influence planting. It would have to be carried along through the season especially in the northern parts, to have an impact. But the market is going to be in a wait and see mode, a weather market mode for the next couple of months while it figures out how much has been planted and what the crop growing conditions are given the moisture that's there. So again, we'll have to see. But right now, using the numbers that in the far right column now that USDA is projecting in their May WASDE for new crop cotton, you can see what I've got circled. They're projecting a big enough supply and not enough demand to bump up ending stocks over 5 million bales. And, they're projecting a 500,000 bale increase year over year, which is, again, not helpful price-wise. I would call the new crop outlook, the bottom line of it, modestly bearish, probably a little bit weaker prices I would expect than what we've seen. So if we have an 85 to 65 cent range for the 24 crop, you can maybe shift that down a few pennies and have a mid 70s to 75 to 65 cent price range would be kind of more what I would expect if the outcome works out according to what USDA is currently forecasting. There's a lot of time. There's a lot of moving parts. We'll have to see how it works out. So I'll just skip to that, Bob, and let the next guy load his stuff. But I appreciate the opportunity to visit with y'all today.
Thank you, Dr. Robinson. Yeah, cotton's going to be a difficult marketing deal, looks like, for this coming year. So appreciate the information, and thank you again for being on with us this morning. So we'll go to Dr. Anderson, and our livestock marketing specialist, and we'll let him give us a little update on what's going on in the cattle market and the livestock market in general.
Well, I'll tell you what, in comparison to some of our crop stuff, I get the good things to talk about, and that's really on the cattle side. I'm going to stick to cattle on this. And, you look at the cattle market, it's just incredible. We're on an incredible run to new record high prices. And these are, this doesn't come around very often, every bunch of years, because we have a cyclical industry. And so it's a pretty exciting time in the cattle market. So, heck, let's just jump right in. And I'm going to just start with calf prices. We'll just take a look at when I talk about record prices, these are 500 to 600 pound number one steers in the Southern Plains. And here we are, we actually touched $4 a pound for an average price, we dropped off a little bit last week, but you compare to where we were a year ago at about 320. You look at that 5-year average, which is my fat red line, which is down there at about $1.79. We have incredibly high prices, and as I go forward talking about prices, fundamentally, we have tighter supplies, and we have what continues to be good demand for beef. People are buying, even at record high prices, and that's reflected really, I think, throughout the all the way from the calf market up to the retail beef market. Now, there's some nuances in between each one of these areas, and we might think about that some too. But really, on the ranch side, on the cow calf side, these are record high prices. The market we're moving in the direction of giving the signal to folks to expand their cow herd if they can. And that's really what price does. Price is giving us a signal, and the signals to expand. And for most people, you think about drought, we think about higher costs, these really high prices, the check in hand for selling that animal has been worth more than her future earnings over her lifetime. But we're getting to prices now that give us an expectation of a future that may look better than just the check in hand, and that gets us to start maybe expanding. And while I don't think we have much evidence of expansion yet, we certainly are on that path to getting pretty darn close. I think there's plenty of ranchers who are, they may have held back a few heifers, or let's wait and see, or some things like that. And so we're on the cusp of some changes, but that just means, even higher prices as we move forward. Fed cattle market certainly been in on the act. I think the fed cattle market here is really a driving force in what we just saw. I showed on the calf market. In the Southern Plains, we hit 220 last week for an average. The 5 market average, which includes Northern Plains as well, hit 226 and change last week as a weekly average. Again, these are record high prices. And if we think about what's going on in the market right this minute, short term, we've got some tighter supplies going to market in terms of fed cattle, but it's also, since April, we talk about grilling season. We talk about kind of the buying patterns switching over from a wintertime type cuts that are popular to ground beef and steaks. And here we are, we're getting close to the end of May here as we tape this, mid to late May. We're sort of past that grilling season purchasing by restaurants and stores that pushes these prices higher. But again, some tighter supplies. This is where we end up, and so certainly much higher prices for fed cattle as well. And if we think about the wholesale market, it's certainly run up higher as well. We hit $3.50 per pound, or $350 per hundredweight as a weekly average last week. These are much higher prices, really led by again, tighter supplies and some of those grilling season purchases, steaks. As we tape this, we're headed into Memorial Day weekend. The kickoff of summer, lots of grilling, lots of steaks, hamburgers, things like that, and we get this kind of seasonal surge in demand that coincides with some tighter supplies. So, in the wholesale market, we got higher prices there as well. Now, if I were to take a look at where fed cattle prices have gone to and where the wholesale market has gone to, this continues to show a real struggle, a real squeezing of margins at the meat packing side, where we've had, I think it's fair to argue, a lot of red ink flowing on the meat packer side of things as we look at margins, simply because that the prices that they're buying at have gone up faster than the wholesale meat market that they're selling at. And so, typically where we are in the cattle cycle with rising prices, we get squeezed in these in the meat packer side. And oftentimes too, we get squeezed on the feedlot side, and it's the ranch side that does well at this time in the cycle. And I think that's what we're seeing in generally now as well, particularly squeezed margins on the meat packer side. When I keep coming back to this idea of tighter supplies, we've got a cattle on feed report that's going to come out on May 23rd. And I think the expectations in that report are for uh, the average is for less cattle to have been placed in April. Certainly, fewer cattle were marketed, and a general decline in the number of cattle on feed. But I think it's worth kind of breaking out how long cattle have been on feed. And what I've got here, we can calculate from that report the number of cattle that have been on feed more than 90 days, but not 120 days yet. So it's that 30-day window back in April. Now we're through that window, but uh, and if we took the number of cattle that have been on feed less than 90 days, it's bigger than a year ago. More than 120 days is bigger than a year ago, but we've had fewer in this kind of middle period. So we look at a pretty sharp decline in the number of fed cattle going to market, fed cattle being slaughtered in the last 6 weeks. And I think it makes some sense with this number of available supplies. Now, we know we've been feeding cattle longer periods of time. So, in a way, this 90 to 120 days kind of harkens back to an older time when we didn't feed cattle as long as we have been in the last couple of years. But again, I think it does highlight this idea of fewer cattle going to slaughter, fewer fed cattle, certainly. And we've had a sharp decline in steer and heifer slaughter over the last 5 or 6 weeks, cutting supplies and giving us this real run in prices. We know weights have certainly been at record highs. Weights have come down a little bit so far this year. We're still well above a year ago, well above the 5-year average. We've made up for fewer cattle by feeding them to heavier weights and getting more tons of beef, more pounds of beef, but from fewer animals. I think this, one of the things I'm going to look at over the next 2 or 3 weeks that I think is going to be pretty interesting is we saw this decline in the last week's data. Now there's a little bit of lag in this data of a week or of a couple weeks, but I want to see if we pull these weights down a little bit more in the coming weeks, simply because we've got fewer animals, we've got a demand for those animals, and we're pulling them forward a little bit quicker, which leads to some lighter weights. So that's something near term I'm pretty interested in taking a look at. I mentioned that steer and heifer slaughter has declined dramatically. What I did here is just real quickly, I took the days of the week, Monday through Saturday. We think of those as the days that were kind of the working days of a packing plant. The red bar is the last 6 weeks. It's 1,000 head per day over there on my vertical axis. I've got Monday, Tuesday, Wednesday, Thursday, Friday, and Saturday. Once we started getting to fewer cattle, Saturday slaughter declined dramatically, and it has remained that way. With all of a sudden fewer animals and slaughter being down 6, 7, 8% in steer and heifers over the last few weeks, I got curious about what day are we cutting those at? Are we doing this? And if you take a look at Friday, we've seen a sharp decline in Friday just in the last 5, 6 weeks of how many cattle we're processing. So what days is lighter? Well, shoot, that's how we're cutting slaughter, is by processing fewer on Friday. I think it's kind of an interesting little change. The end result is beef production. I circled it here over the last few weeks. We've been down 7, 8% on beef production. You combine 7% less beef than a year ago in the last few weeks with seasonal demand, and we get those record prices running. And it's pretty interesting, I think. I think from a supply standpoint, we can take a look at why prices are higher. We know we've closed the border again to cattle imports from Mexico. As we get that data, I think we'll see that blue line drop off to zero. Again, a little lag in the data. So we're really we are curtailing the number of feeder cattle available to go to our feedlots because the border is being closed. And so I think it's worth pointing that out, worth remembering that a little bit tighter supplies of cattle relate to a little bit higher prices and tighter supplies of fed cattle and beef down the road from closing the border. I wanted to show one thing. This gobbledygook of lines is our we do get some data on exports of beef muscle cuts. I'm interested in that because we export beef. We also export stuff that doesn't show up in here, like the variety meats, offals, hides, stuff like that. The kind of the black and green line is Japan and South Korea, our two biggest markets. The purple and blue down there towards the bottom is Canada and Mexico, number 4 and 5 of our export markets. The red line in the middle is what we export to China. And with the tariffs that have been our tariffs on them on imports, their retaliatory tariffs really show up in some effects on beef muscle cuts. And if you take a look at that thing, it dropped to darn near zero very rapidly over the course of just a couple of weeks as the tariffs took hold. As we start looking for effects and impacts of tariffs, that's our third biggest export market. We exported last year about 11% of our beef production. China was our third biggest market, and that accounted for about 1.7% of our total beef production went to that one market. So we do see an effect on exports from these high levels of tariffs. This negotiation to a lower level that has occurred, we'll see if we see any little bit of any kind of rebound in that. But again, I think that just highlights that certainly on this beef side, because we're talking exports, we're not talking our tariff, we're talking other countries' retaliation. That's the country that's had the largest retaliatory tariff impacts. And so that's where we see an effect of the tariffs. If we look at those other countries, there's not much change. In fact, there's a few countries we've exported a little bit more to. And so maybe some redirection of product for export. But, I think it's worth pointing out that's where we are. But overall, I do think we get into summer, prices come down as they normally do seasonally. But so far, folks are buying beef and the demand is supporting prices where we are today. And so with that, I probably yacked on more than I should have, more than I was supposed to, but I think we got a lot of pretty interesting stuff happening and good stuff happening in the cattle market.
Yeah, the cattle market is extremely wild at the moment. It's kind of hard to imagine the amount of money that a little jag of cattle puts in a producer's pocket at this moment in time. So
It's
it's
an
pretty,
amazing,
it's a
it's an
pretty,
amazing thing.
it's a pretty crazy deal. But again, thank you, and I guess we'll get to ride this way for as long as it'll stay up. So but what comes up goes up, usually comes down. So
Sooner or later it
anyway,
comes down.
but it's fun at the moment. So
Yeah.
anyway, with that, thank you again, Dr. Anderson. Appreciate you being on this morning.
Glad to do it.
We'll move on into Dr. Welch with the grain marketing side of things. So I'll turn it over to him and let him get started.
All right. Thank you, Bobby. Let's see if we can get this up and rolling here. And again, appreciate you putting this meeting together for us again this month. And you're going to hear me touch on several topics that Dr. Robinson talked about in the Cotton Outlook, and that Dr. Anderson certainly mentioned in his livestock outlook for us, that corn and the grain markets will kind of play into some of those. Both things that they mentioned are very, very important in aspects of our grain markets as we look at the factors of supply on one side and demand on the other, and how those all interact to determine and discover the price of grain at any one time. And we're going to talk about some of the challenges short term along the supply side. A lot of focus, weather, obviously. Acreage is still not settled. As Dr. Robinson mentioned, we really won't have another good look at that until the end of June. But we do have some indications of perhaps some weather prospects impacting some yield potential. And then, of course, on the demand side, we have some important developments on domestic use for grain, but then certainly the uncertainty and the disruptions around tariffs and trade is a big deal. So we jump into that. First, look at those. I'd like to start with USDA's numbers that came out in the May WASDE, the World Agricultural Supply and Demand Estimates. This is USDA's first official outlook for the 2025 crops. And we're looking at corn on this table. And the supply numbers were not a surprise at all. When farmers were surveyed back in March, they told us they were going to plant 95 million acres of corn. which is, up almost, 4 million acres, a little more than that from 2024. So we knew big acres were coming at 181 bushels per acre. That's USDA has been using that number since last November. In fact, that's, I think, the opening number they used in the 2024 WASDE. I think with average weather and trendline yield growth, a yield of that 181 certainly seems within the realm of possibility, which would be about 2 bushels higher than 2024. Beginning stocks are actually a little lower because of some better consumption numbers out of the old crop, corn crop, but still record production, record supply. We've never had a corn supply of 17 billion bushels before. And so given these kind of numbers, that's what you come out with for total supply of corn for the 2025-26 marketing year. So then what about the use components to offset that 3.6% increase in supply? And we are seeing a record projected domestic use. And we'll talk about where that comes from in just a minute. But corn exports, that's a really strong number. They raised export projections for the old crop marketing year for the 24 corn crop, and then have raised it again going into 2025. So given the size of Brazil's crop, looks like China will be staying in the corn market. They're not buying our corn now, but that's a pretty strong number when it comes to for exports. And we'll put that perspective also here with the next slide. So total use is up, not as much as supply, and of course, raising ending stocks to a 1.8 billion bushels, days of use on hand. Our stocks to use ratio goes from a 34-day carryover back up to about a 42, 43-day carryover. So that's a recipe for lower prices from where we've been, and certainly that's USDA's projection coming down another step lower in 2025 for a little bit lower. That's a national average price of corn paid to the farmers over the course of the marketing year. And where did those use numbers come from? Let's start with that feed number. The domestic use numbers, fuel's held steady, which to me makes a lot of sense. Gasoline demand is really not growing. There have been a few tweaks to ethanol policy, but not enough really to shift that needle. And so we're holding corn for fuel steady. That's a really good corn for feed number. Goes back the highest of the last 10 years or so. And again, that in the context of some challenges around numbers of livestock and poultry that are consuming grain. But as Dr. Anderson was mentioning, if we're feeding those animals longer, putting more weight on them, perhaps that's the foundation for USDA's pretty aggressive increase in feed use, which raises our domestic number, and then exports. If that number holds, that would be the second highest level of exports we've seen in some, going back over 45 years. So that would be a really good export number if it can hold, particularly given all the uncertainty in the current trade environment. And the price slide that we would expect with that increase of days of use on hand, again, going from that 33, 34-day level, and the prices typically associated with those tighter supplies, shift that back up above the 40-day threshold, which is really critical for corn. And we're back down to prices that $4.25 or $4 again for the national average cash price. And so the projections that USDA is leaving with our ending stocks and our stocks to use number, it would be very consistent with that typical price relationship between the season average farm price and that days of use on hand. In fact, just about right on what models would predict given those kinds of numbers. Yield, that's a trendline yield growth from 1950, and that's growing at about 2 bushels per acre, 2 bushels per year, per acre. And so for actually a straight trendline yield would get us up to about 183 bushels per acre. For the USDA to use 181, adding 2 bushels to last year's crop would make a lot of sense given normal or average conditions. That then leads to how normal and average are growing conditions for 2025. And how are we starting out? This is the drought map from May the 6th on the right, and then last week, May the 13th on the left. And what I'm trying to track is just some short-term changes in this drought monitor. And you can see that a good portion of the eastern Corn Belt is still in pretty good shape. However, last week's monitor showed some increasing dryness creeping in across northern Illinois, northern Indiana, southern Wisconsin, areas that are drier last week than they were the week before. But the real concern is out here in the west and far western Dakotas and Nebraska. We don't grow much corn out here, but in the eastern half of Nebraska, we grow a lot of corn. And to see that red area that's extreme drought expand to more counties in northeastern Nebraska, and then the severe drought expand over more of the central part of the state compared with where we were a week ago. So that's not a good trend in terms of protecting yield potential. Now, see how these storms this last week may have altered that map. But to watch that and to monitor that in terms of our projections yield, there's some really good information that comes from the Iowa Environmental Mesonet. And I'll be glad to provide information around this data source as well as how to interpret these charts if folks are interested. But there's three, I think, key measures that really help us keep track of what yield potential might be in some key corn growing areas. What I'm focusing on in this first chart is the Southeast Climate Division of Iowa. This is the geographical center of the U.S. Corn Belt. And what we're tracking here is the accumulation of growing degree days and trying to get a measure, is this a warmer or cooler growing season to this point than normal? Then we look at accumulated precipitation. Of course, obviously, that's certainly important to keep a track on. And then this third chart down here is what they call a stress degree base, with 86 degrees being the upper threshold. And what this measure is the accumulated number of days over, where the high temperature is over 86. With the agronomic principle behind this is that over 86 degrees starts to put some stress on a corn crop. Corn just doesn't do as well when it gets that hot. And so are we seeing an accumulation of days with these extraordinarily or abnormally high temperatures? And so starting with growing degree days, I've got the black line is the long-term average. The blue shaded area is the record high and the record low. And then the green line is 2024 records, and 2025 are the measurements from 2025, the current growing season. You can see that this year, the growing degree day accumulation is warmer than normal, just like it was last year. Not excessive at this point, but we are seeing this warming pattern above normal warmer pattern, accumulating growing degrees faster as we're getting into May. Combine that within this particular area, it hasn't rained in 2 weeks. Now, we're just getting the crop planted and up and going. But this will be an area of concern to see if this happens to continue and stretch out as we get into June and, of course, further into the season. But a key measure of how are we doing keeping up with our precipitation accumulation numbers. You can see last year at this time, we were near record highs here at the first part of May. And this year, we've got a dry stretch going on and starting to see some heat starting to build up. And obviously, that's the combination that'll take the top off the yield. Not only that the moisture is starting to perhaps get thin, but also then add heat to that. And that really has some yield effects. Let's look at Nebraska, that Northeast Climate Division in Nebraska. We've had a surge of warmer weather here in May. That growing degree, we're accumulating those much more quickly than normal. Again, it's early, not really hurting us yet. We're just trying to get the crop up and going. Starting to see that heat starting to build, and it's been below normal precipitation in that region since the middle of April. Again, a long stretch of very little in the way of additional rainfall, but they are well below their average numbers and well below, much below where they were a year ago. And again, you can note the degree of stress degree accumulation as we got into that second week of May, had that it got hot. And again, it's early, but something to keep on track of. How are we doing here in Texas? This is the Texas South Central Climate Division. So it kind of covers this, Brazos Valley and kind of the southeast region of Texas. It's been warmer than normal through April and May. Our rainfall has been keeping up pretty well. We haven't gotten above average through April and May, but we've kind of touched it. But we too are hitting a dry spell now. We've gone a week or 10 days without a rain, and combine that with now a significant increase in hot weather. And that's why we're trying to get this corn crop finished as early as we can, because this can start to have those yield debilitating effects. To see that combination of it's getting hot, and we're also not getting that rain, perhaps, and the humidity to help offset some of the impacts of that hotter weather. So certainly will likely have as far as long as we want the Texas crop, we're at the area now. Silking, tasseling up in this part of the world, these key reproductive stages of the corn crop is you're not wanting to see that combination of heat and drought hitting the crop right now. Certainly has some yield impacts. So we'll see how that unfolds. But again, some great monitors for that situation. World corn production for the next marketing year. These are the top producers. 81% of world corn supplies come from these areas, and every one of them is higher this year than last year. The biggest increase here in the U.S., China, a very moderate increase, but still a record high. Brazil staying good. EU hanging in there over the last couple of years. Argentina's a good crop. Again, just every major contributor looks for bigger production. And this is, I think, a very interesting undertone of what could play out for the marketing year. If you look at that days of use on hand, and we showed how in the U.S. you build that days of use on hand, which are these purple bars. When that goes up, that puts downward pressure on prices. Well, globally, outside the U.S., that situation is getting tighter and tighter and tighter. So the foreign days of use on hand is the lowest it's been since 2012. In the U.S., we're relatively low levels, but we're trying to crawl back up, perhaps to where we were in these relatively low price years of 2014, 15, 16, 17, 18, 19. Those were really tough years price wise. And so the question will be, as we play into 2025, even though we have, looks like, more adequate U.S. supplies, the total foreign corn crop is a tighter situation. So if there happened to be a disruption, production issue around any of those major corn producers, I think we have an undertone or the likelihood for a lot of volatility in our corn prices, even though things look pretty good here, a great deal of sensitivity due to the tight carryover to use situation outside the U.S. And futures prices had a nice run from January to February. Then with, I think, as has been mentioned, the tariff disruptions and all the talk about what this trade situation is going to be, what's the economy going to do, we've been setting those prices lower now, trying to get a little bit of a rebound. And I think some of that is going to be associated with weather concerns, with the drought perhaps building in the Corn Belt and what that could yield. And so we'll see if we don't typically get our normal run up into toward June until we do get a better handle on got the crop planted, what kind of shape is it in, what's the long-term weather outlook, what's our acreage number, before typically we would see those prices fall off into July all the way down to September. Sorghum, right quick. The balance sheet for sorghum looks like a significant increase in sorghum supplies. USDA raised the planted acres, they raised the yield. Production is up significantly over last year, as are carryover stocks. So we've got an 18% projected larger sorghum crop for 2025 compared to 2024. And that is more than compensated by an increase in use. USDA has lowered the domestic use category in a big rebound in exports, which would be a recipe for a better price relationship for sorghum relative to corn if we're exporting more of that corn crop. So again, a 25% increase in use given these numbers, getting our ending stocks down to about a 39-day carryover. The season average farm price is moving exact opposite of what you would expect, given those kind of supply and demand dynamics. But corn and sorghum are going to move together. The difference being that when we see sorghum exports stronger relative to our domestic use, such as we were in 2023 and we're projecting for 2025, that generally puts the sorghum price relative to corn in a much more positive relationship. When we see domestic use much higher than exports, that tends to put pressure on that price relationship. And we see a bigger negative basis for sorghum relative to corn. And the export sales, where are we right now in this old crop marketing year for sorghum? Again, we're trying to get to 100 million bushels. We're not at 60 and really struggling with export sales. And basically, we've lost the China market in this current tariff and trade situation, picking up a little bit more from some of these other traders. But with China shut off, these other participants, maybe they're a little bigger, they're a bigger piece of a smaller pie, is what that boils down to. And so it's going to be a challenge to even get to 100. And then USDA is projecting 250 million bushels next year, which is, again, a very aggressive number. And this just plots out that relationship just a little bit. This is the ratio of sorghum exports to domestic use. Divide exports by domestic use, and when the exports are 2 to 3 times domestic use, that's typically related to these very high sorghum premiums relative to corn. When you see domestic use higher than export, say 1-to-1 ratio, or where we are currently now, a 0.5 relationship, in that domestic use is twice exports, that typically puts a lot of pressure on that price relationship. And so we're struggling right now. If that forecast holds for a strong rebound, that would be good news for the sorghum price. But again, we've got a long way to go, I think, to reestablish a situation in which that the export market's going to look that strong again. So I'll stop right there. Appreciate the time today. Again, I think, of course, weather is going to be our primary price controlling event, particularly in the short term. But over the longer term, setting that relationship of trade is going to be very, very important for us to have those marketing opportunities and access to those global markets, which are so important to all of our grain markets, but especially when it comes to sorghum. Bobby, I'll turn it back over to you.
Thank you, Dr. Welch. It's like I said, it's always a pleasure to have you on and look at all the variables that come into play on a regular basis in the ag world, and especially the ag marketing world. So great information, and thank you. As normal, we have a commodity representative, which usually well, we've had the Texas Sorghum Producers Board, Texas Corn Producers Board, and the Cotton Board have all been sponsors for our update, and we appreciate them and all that they do for this little effort. And this morning we have Mr. Wayne Cleveland, who's the executive director of the Texas Sorghum Producers Board. Always a pleasure to have him on. There's always a lot of good information comes to us, and with that said, I will turn it over to Wayne.
Well, thank you, Bobby. Can you guys hear me okay?
Yes, sir. All's good.
Okay. All righty. I always enjoy seeing Dr. Welch's presentations. In my mind, that's what I'm going to present. And then I realize his capacity to build those slides is really second to none. And some really good information in there. Probably what I'm going to lean into more and what we get more than anything else today is where is China in the market. We've had quite a good run over the last, I'd say, month or so. We've had myself, I've been at the Grainscom, just got back from there literally in the last couple of days, where we met with all of our European customers, which would include Spain, which is becoming more and more important in our market, and sent Ty Wilson over to China. They had a grain and feed show over there last week, as well as calling on all of our customers in China, which is where all eyes remain right now. Traditionally, you guys saw that ratio of domestic to export. We see sorghum trade at about 118% the value of corn when China's in the market. So we're not seeing that now. We're seeing a negative basis on the coast. We're seeing basically no grain sorghum into movement. If you guys are on from anybody close to the valley, you know that usually there's a bid right now and there's a negative basis there. All of that hinges on China and the trade agreement. To be upfront about the market right now, and to put it in relation to corn, China has around 200 million metric tons of corn in their strategic reserves, which is basically a year's supply for them. That corn is not stored traditionally like we see it here in elevators and port facilities. It's stored for the most part on farm. The government owns some of it. They put it out in auctions, which they haven't done recently. That corn probably at auction would be around 2,500 RMB, which is not a high price in China. It's not the typical $11 a bushel that they're used to, just because supply and demand there. But China saw clearly the trade war coming down the tube and loaded up on corn. They loaded up on sorghum, but there wasn't a lot available at the time. So, and I was trying to find it, but I couldn't. I apologize. Sorghum's balance sheet in China right now is zero. There's no grain sorghum in China other than two people, Junji and I believe Four Gardeners owns a couple of vessels that they brought in and unloaded to be in this position for the baijiu makers. So if you're buying sorghum that was sourced from the U.S. and China right now, you're a very wealthy person. You're paying out the nose for it because there's no sorghum moving. We gleaned quite a bit from our calls in Europe from Bunge, ADM, Cargill. Basically, what we're seeing is a very stagnant world trade for grain sorghum. Ranges anywhere from 240 to 320 a metric ton, which is a pretty decent price. And for reference, in 2018, when the boats were turned around, those boats were worth about $325 a ton. Prices were a little more robust. Interest was a little less back then. Those boats actually ended up in Spain, which is we're seeing grain sorghum move into Spain now. We met with David Vila, who owns a company called Riera Roura, who's buying as much grain sorghum as he can. He's bought two boats. And what you see in the international trade right now, sorghum is extremely cheap and you're able to sell it at an extremely high price. The risk associated with buying cheap sorghum and selling expensive sorghum is you buy a boat, it gets on the water, and the tariff change. Regardless of what your political flavor is, that's the reality of the market. You've got folks that are just terrified to buy grain sorghum or any commodity for that matter right now because those rules can change overnight. Honestly, they're concerned about the president changing those just in the middle of the night, as they tell us. So the folks that are buying this are extremely cautious. We'll have that group from Spain. I'm working on that as we speak to bring those guys over. They're not familiar with sorghum, honestly, with the infrastructure of it. We'll get them in some fields to see that. So Spain provides a really good outlet, a secondary market. I think you'll see Turkey lower their 130% tariff on sorghum. We've been visiting with them. We've spent some time there. I've been over there in the last 6 months. They used to buy a lot of sorghum. They will buy sorghum, but they won't buy it at China prices. And I preface this with all growers is don't get excited about international markets and thinking it's going to make this more valuable than corn. It's not. Our sales technique is pretty simple. Mexico buys it at 88 to 90% the value of corn. And if you see it start approaching that, you better have your buying shoes on because you're not going to get it lower than 88, 85% the value of corn. Mexico will suck that up. And we're seeing them do that right now. Earlier this morning, we were working on a phytosanitary issue where we used to send multiple trucks across the border with one phytosanitary certificate. Reading an edict from APHIS today saying that they're going to start requiring a phyto certificate on every truck. It's going to be very harmful to our market. It'll add 10 or 20 cents a bushel to that, which will go straight back to the grower. And right now, with the basis where it is, absolutely cannot stand that. I will tell you that China is very interested in getting the tariffs on sorghum gone, and there's some talk last week about sorghum being lowered to 10%. China is not, they're a grain deficit, they're a food deficit country. So they're going to start feeling the squeeze of all of these commodities. As it stands today, the timeline on those tariffs for ag imports, you got soybeans at 23% and corn 26%. Corn beyond the quota is 90%. Wheat is 26%. Wheat beyond quota is a 90%. Sorghum's at 23%, and there is no tariff rate quota on sorghum. Pork at 32%, beef at 32%, and cotton at 26%. We're actually at a 20% tariff. I don't know how that happened. Those numbers stack on each other, but you're seeing a lot of interest from China and taking a huge risk trying to get a boat across there in the next 60 days, which is part of the 90-day let's make a deal, whatever it was called, that ends in 60 days, remember. And That's clearly what President Trump has said, but there is a lot of talk about getting some sorghum in there, and I think there are some people that have enough tenacity to do that. It takes at least 60 days to get sorghum bought in a boat on the water across the water to China. So you can see the margins are really thin right now, but nothing's going to pay like China is. I just tell growers that you're not going to see that market. So we're going to have a storage issue if we don't start selling some grain sorghum and getting it out of the system. Again, a lot of ifs and buts out there for now, but I sit on the Ag Trade Advisory Committee. I can tell you, as well as the other folks, that Jameson Greer, the USTR, I think he's got probably the best beat on agricultural trade as any USTR in a long time. I think Greg Dowd was the ag trade guy, certainly had ag interest, but Jameson Greer, I think, has taken this opportunity to enhance agriculture. I think will emerge at the end of it a lot better for our export community. And they're working as hard as they can. I know it seems sometimes like a house made of cards, but USTR is working really hard on behalf of agriculture, and they're including the groups. They're letting us come in and say what we need. So, Bobby, appreciate the time. Glad I got to see Mark's presentation. If you guys have any questions, feel free to give me a call. I'll be available the next couple of days.
Great. Again, just appreciate you getting up with us this morning. Like I said, it's always a lot of good information comes our way from our commodity people, and we appreciate your support and helping us out with this endeavor. So, also to all of our specialists, we're again grateful for you and what you do for this. But if there's no questions, and I didn't get anything in the chat, so till next time, well, I guess this is a wrap, and appreciate it.
Thanks, everybody. Good to see you this morning.
Y'all have a good day.
You too.